Welcome to the Bucket Plan on Demand, a podcast for financial advisors based on the best-selling book and process that simplifies financial planning. Hear from skilled industry professionals and special guests each episode that will help perfect your approach with clients and your results.
Good morning, everyone. Welcome to another Coffee Break with C2P. So glad for you to join us here this morning for a very important topic, obviously a little bit of a breaking news topic. So unless you've been living under a rock or have no news feeds, you're probably aware of the one big beautiful bill. That is so hard to say. So we got to go with like OB3 or something, some other terminology.
I like that.
Yeah,
I've been saying OBBB, but OB3 I like.
Yeah, something like that. We're gonna have to break it down differently. But joining us today is our obviously our guest barista is a man that really does not need any introduction, but no one better probably in the entire country to talk about the one big beautiful bill and really break down the tax implications is none other than Dave Alison, obviously founding partner here at C2P, founder of Alison Wealth Management, and also creator of the Tax Management Journey. But Dave, let's get right into it. Let's talk about the OB3, as I'm now going to call it going forward. I think most people probably have a baseline understanding of kind of the high level things that are in this bill. But what do you think advisors should specifically be paying attention to, as especially relates to, obviously advice they're giving to their clients?
I think for one, you're too generous. I don't think Congress even knows what's in this bill. It is big, and there's a lot of really good stuff in here, though. I think most people, understand the headlines and kind of what the table stakes were, especially as it relates to planning with kind of our core market, the, pre-retiree, the retiree. Obviously there was a lot of things from Tax Cuts and Jobs Act that were scheduled to sunset at the end of this year. It was going to create a pretty large tax increase on virtually everyone out there. It was going to change the tax code. And so, the biggest headline of this whole thing is making a lot of the Tax Cuts and Jobs Act provisions permanent. That is inclusive of the current brackets that we're in right now. That's inclusive of, some of the other provisions that we do planning around, a higher standard deduction, qualified business income, some changes to the estate and gift tax exemption. And so, I've been having a lot of conversations with my clients. I think, some people know, I basically kind of crawled into a hole on Friday and just popped my head out yesterday, pretty much, analyzing every aspect of this bill and how we can create opportunities. I actually have just finalized a 70-page guide for financial advisors on all the different strategies and opportunities that, it's over in Matt Seitz's hands right now. Marketing's making it look a little pretty, but, I'm going through all kinds of case studies and examples of things that we can share with our clients that I think can provide tremendous value. And the one thing that really jumped out at me when this thing was actually signed into law and I started to get my hands on the final version is, I think most people know, in 2017 with the Tax Cuts and Jobs Act, I would say it was probably the most pivotal year for me as an advisor. I saw that tax bill and I was just like, wow, my head exploded in terms of the opportunity and the value that we can share with our clients to help them, understand that not all money is taxed the same. And through proactive tax management, we could help them reduce their lifetime taxes. And honestly, over the weekend, I've kind of had that same epiphany with this new tax bill. This thing is enormous, and there are so many opportunities for our retirees, for our high income clients, for our ultra high net worth clients, for our business owners. This thing is stacked with stuff for business owners. I mean, Trump, love him or hate him, and whatever side of the aisle you agree upon politically, he had a very set agenda, to try to encourage business investment in the United States. And you can see a lot of that in this bill of what the final legislation was. And I think that brings huge opportunities to our clients. And so, me, Jason, Matt Seitz, our team, we've been just kind of giddy over the last few days of the opportunity for marketing that we're going to have, and again, keeping our advisors at Prosperity and at C2P ahead of the game. And I think that's what this guide is going to do. So, I'm happy to talk about some of the things that jump out to me, but, the one thing more than anything else that jumps out to me is just marketing. This thing is going to enable us to continue to drive the marketing story of, clients need proactive tax management. It's not what you make, it's what you keep. And, the 7 simple words I say over and over and over with the tax management journey, not all money is taxed the same. This bill really drives that point home.
You mentioned obviously the marketing side, Dave. What do you think if advisors aren't, leveraging this bill? Is it, what's the impact on their business? Are they going to lose clients? Is this, is this one of those things where you mentioned the Tax Cuts and Job Act being transformative? Do you think this is the same thing in that, hey, if you don't really start proactively talking to your clients about this, you might have other advisors that are going to, poach clients? Is this kind of event where you really got to get ahead of this curve?
Yeah, I think so. I mean, the reality of it is we all know our clients want advisors who are proactive, not reactive. They want to understand how these things impact them. I mean, it's hitting every major, news headline out there constantly. So it's a big deal. And I think people always want to see kind of what's in it for me and am I taking advantage of everything? I mean, that's why the first thing I did when I woke up Monday morning is I filmed those quick videos. And Matt's team at C2P got them turned around and pushed out to all of you really quickly. And I'd highly recommend, take your own script, do your own video, use my video, send it out, just get this information out to your clients to know that you're on top of it and you're thinking about them. I mean, I've probably, and our team, we added this to our L10 on Monday, just talking about what clients we need to prioritize to have some of these conversations with. And so yeah, I think, it's an opportunity to show that you're ahead of this thing. I think a lot of advisors, are kind of sitting back, just waiting. And then we're working on scheduling a webinar. I was actually supposed to be on vacation, but I'm gonna, host a couple hour or two, whatever it takes, webinar to kind of just walk through some of these changes to make sure everyone's up to speed with them. Because again, this stuff impacts everybody. And the great thing about your core market, like your retirees, your kind of mid-income individuals, the great thing is there's not a lot of new stuff for you to particularly learn. What it does, though, is it gives us confidence to carry on and continue our planning opportunities, right? We know tax rates are low right now. Tax rates are going to continue to be low. We actually have increased standard deductions now, both in the regular standard deduction. Even the 2025 standard deduction has been increased slightly under the OB3. But then, for our senior clients over 65, we have bonus senior deductions. And so there's a lot more income that we can potentially create. But then there's also some traps that if we're not aware of how this legislation works, we could actually be giving inaccurate advice, particularly around Roth conversion. So, some of these, pretty much most of these provisions have different phase in and phase outs of income levels. And so, if I'm going into planning with a client that maybe is a mid-income, $125,000, $130,000 a year retiree, and we're thinking about doing bracket bumping Roth conversion strategies, I could actually create even more unnecessary or avoidable tax because now I might do a Roth conversion that actually phases them out of the senior deduction, for example. And so those are really important things that we all just need to go into, our planning with eyes wide open. And, a lot of these changes are actually in effect as of right now. So they're not stuff that's going to give us the next 2, 3, 4 months to learn about. It's stuff that's going to impact the decisions that we're making every single day with our clients. And so, Kalem, when I built this guide, and again, it is, assuming I don't add more to it tonight, it is 70 pages.
We're locking you out, Dave.
What's that?
I
He's
said
not
we're
going to
gonna
let you
lock
edit
you
it
out.
anymore.
No,
Yeah.
I'm not. Don't lock me out. I'll create a new version of it and create more work for you. But it is literally 70 pages of ideas and strategies. And why I wanted to add, not just the provisions, but I wanted to give you examples and strategies of how we would apply these. These are the stories. I even broke everyone down into talking points. If you have clients in this specific example, here's some talking points of how you could talk about how this change creates opportunities for them. So that's all huge, huge marketing opportunities, client experience opportunities. But when I kind of break it down, I broke it into chapters or sections. Right now there's 12 of them. And these are the big things that I know I want to know as an advisor to be able to go bring value to clients. And I can share, at a high level, those 12. Obviously, in a couple weeks at Tax Management Journey here in Charleston, we're going to do a little bit deeper dive reviewing the guide. Yeah, there's just a huge amount of opportunity, Kalem.
So it sounds like, obviously advisors need to educate themselves. So we've made that easy or easier. I mean, 70 pages is better than 900. So that's already an improvement, right? Like,
Right.
so we made it easier with the guide. You mentioned videos we've already put out that they can, obviously re-record, share with their clients. Tax Management Journey, obviously we're adjusting some of the content for Tax Management Journey and incorporating OB3. Thinking like on the prospecting side, is there anything you think is really important to kind of maybe key in or look at specifically that you're kind of picking out of this bill to say, hey, this is gonna, this messaging, this is really where we're gonna create, kind of that new client opportunity?
100%. I mean, the time to take action is now. That's the message. Like, I just looked at the US debt clock this morning, $37 trillion of debt. This bill is going to add more debt. Now, the counter of that is this bill, according to the people that support it, should also create a lot of stimulus and growth, and maybe that growth can offset this giant debt issue that we have. But we still have a giant debt issue, and this is adding more debt. And so the reality of permanent, in the words of Congress, is not permanent, right? We all know permanent really means temporary. It means until a new administration gets in and can try to create new policy. And so I think what we do is, we have a gift from Congress right now that all of the great planning that we've been doing for our prior clients, up until the sunsetting deadlines that we thought were imminent and in front of us, have now been extended. And the majority of this population has not done any planning regarding this. And so, again, I think that's the message is like, we don't have an unlimited timeline. We know where rates are now, and it's going to take another act of Congress to change a lot of these things because they were now permanent. They weren't sunsetting provisions, but permanent does not mean permanent in the words or in the world of Congress. And so, again, I think the iron is just hot to strike right now. And again, I go into like what some of these changes are today. Some of these things are going to even, go away this year. Like your clients, if they want to make like EV investments, buy a Tesla, they want to, make some improvements to their home, they got some deadlines to get that stuff done, or else they're going to be completely exited out of some of those credits. And so again, just a big opportunity to share like, hey, I have this information. And like one of the messages we sent out to our clients is like, we have this information. If you're thinking of doing any of these things, just let us know and let us think through this. If you're thinking of making an investment in your business, buying equipment, buying a building, buying a EV car, like just reach out to us and let us help you think through this strategically before you do that. And so I think that's the key in communication is like, there's some immediacy to this, but then there's also, probably another 3 really solid years of planning that we can engage in. And, I kind of give that window of 3 years because, the reality of it is, we'll probably have a new administration in and, this debt issue is going to continue to compound on us.
And maybe Matt, you might want to chime in on this as well. Is there anything that advisors should be focusing? Like you mentioned, like EV credits, obviously. Like, is there some urgency things? You mentioned some things that obviously are going to expire at the end of the year. Like, what are those things that are kind of the ones that are maybe the most immediate? You mentioned obviously the extension of the tax rates and stuff from the Tax Cuts and Job Act. That's going to continue for at least several more years. Like you said, it's never permanent. But is there those opportunities that you really want to get in front of your clients or prospects right now today? Because you're like, hey, if you don't do this by the end of the year, it's gone forever. You mentioned like obviously the EV credits. Is there other things like that are maybe a little bit more important?
No, I mean, the EV's the only one that's like kind of under the gun, and it's not even by the end of the year. Like some of this stuff starts to go away, I believe, as soon as September. Right. And you'll see all the key milestones and dates. I talk about implementation timeframes in the guide that we're going to send out. But the other thing is like maybe some of the planning that you already accounted for with clients, you might want to take another look at some of that stuff. Because again, some of these additional deductions and exemptions go into effect this year. And so I think, it's going to be a busy tax management season come, Q3 and Q4, with regard to all of this stuff. And I see Pete asked, were you surprised how quickly this bill passed? Usually we have to wait till until late December. You know what? I wasn't. And I felt like Trump was so strong-headed about saying we're getting a bill done by July 4th that, they had the support of it. Obviously there was a couple key people they had to convince and get over the sideline. But I'll tell you what, I'm certainly glad it didn't come in December because there's provisions that affect this year. And, we've seen, especially with Tax Cuts and Jobs Act, how disastrous it is to pass a bill in November or December. So again, the reality of it is this just gives us all a great head start into, advancing some strategies for our clients.
Yeah, we'd rather have Christmas in July with this bill than have it pass right before Christmas in December.
So Kalem, let me do this real quick. And again, if anyone has any questions, obviously I can't get into teaching this stuff. This is going to be a few hour webinar, and again, a large guide. But
I thought everyone agreed we do 2 hours today. Is that not what everyone agreed to?
You want to do that? I'll do it. So, so let's talk when I think about the opportunities here, I'll just run down, but the big one that we should all be kind of talking to clients about is the permanent lower tax brackets in combination with the amount of debt. And it's not just the ordinary income brackets. I'm going to talk a lot in the guide about, again, the capital gains brackets, right? So, there's more certainty in capital gains now. We have that 0% bracket. There's huge planning opportunities. We all know Roth conversions, bracket bumping Roth conversions, and implementation around strategies like this. The second is the estate and gift tax exemption. So most people saw, the exemption was set to sunset and get cut in half. Under this new provision, not only does it not get cut in half, it goes up to $15 million per person. So that's $30 million a couple could potentially transfer on income tax free or get out of their taxable estate. I mean, $30 million at a 40% estate tax is a $12 million income tax savings or estate tax savings, by doing the right type of planning today for our high net worth and our ultra high net worth clients. And so again, what this gives me confidence about, I can't tell you how many clients we've drafted irrevocable trusts for, we've drafted slats, we've drafted dynasty trusts, we've drafted inheritance trusts. But guess what? I haven't done any gifting yet, right? I haven't funded them because I wanted to have confidence to see what some of these exemption changes are. This now starts to give us the confidence to execute some of the good planning work we've already done. And there's a lot of opportunities, even just in kind of how we think about that type of work. The third kind of chapter that I highlight is the SALT tax deduction changes. So state and local tax Cuts and Jobs Act put a cap at $10,000. That really hurt people on the left coast and the right coast, right? And so, what this change did is it actually increased the SALT deduction to $40,000. But there's an income phase out starting at $500,000 of income. And so for our higher income clients, there's a lot of income tax management that becomes really, really important here, because there's a level that SALT tax deduction goes from 40 grand all the way back down to $10,000 at 600,000. That gap of 100,000 to 600,000, that's $100,000 of income that can effectively cause a tax rate of 130%, when you factor in the increased income and the decreased SALT deduction. So there's a lot of planning that can be done here. If we have pass-through entities, we've kind of solidified that we know we can continue to do the PTET tax, where we're using pass-through entities to pay state and local tax deduction, through the business and get a full write-off. If, we have real estate investment clients, we could actually set up a series of non-grantor trusts that own the property. So, for example, if I own a $3 million property and I'm paying 90 grand a year in state and local income tax on that property, and it's generating 400 grand of income or 500 grand of income, Maybe I set up 3 irrevocable non-grantor trusts that own that property, and each grantor trust gets its own SALT deduction of 40 grand. Now I've captured that full deduction. So like there's really unique strategies for business owners, using trusts, and then really just on income tax management of that $500,000 to $600,000 phase in. We've got a whole slew of new deductions available, but then also there's a new itemized deduction limitation. So the government basically said, hey, for people that are in the 37% bracket, we're no longer going to give them a 37% marginal deduction when they itemize. Many of us remember the old PEAS limitations on itemized deductions. They are not back, but they're a variation, maybe a distant cousin of that for our high income people. What that basically says is that when you itemize deductions, if you have any income pushed into the 37% bracket, you're only getting a 35% deduction for that income. So some things to navigate, in terms of how we think about, especially like our clients that are making large charitable gifts and itemizing, they're going to have some of that deduction reduced for them. And that's effective in 2026. The new deductions, I think we all have heard no tax on tips, no tax on some tips, no tax on overtime. No, that's no tax on some overtime for certain people. The senior deduction is going to be mega important for all of us because we're mostly working with, that middle income retiree. So that's something big. And that senior deduction, there's kind of a double-edged sword to that because maybe that creates more opportunity to accelerate income, realize capital gains, do Roth conversions. But we have to be meticulous on how we plan to not actually phase our seniors out of that deduction by doing too much. There's auto loan interest deductions now. Again, income phase outs around that. So, when I go through chapter 5, these new tax deductions and credits, you're going to see how important strategic income planning is going to be around these phase out levels. And most of these things are around modified adjusted gross income. And so we need to account for maybe even our seniors who we were building large muni bond portfolios for part of their income. Now we need to really engage in MAGI planning again instead of just adjusted gross income. There's some child-related tax benefits. So they did some enhancements to the child tax credit. So some of your clients might experience an increased credit there. We have, of course, the Trump accounts now. And so I go through a whole analysis on Trump accounts and, the comparison of 529s to Roth IRAs to Coverdales to different savings vehicles we can do for children. So, it's just something that I'm sure our clients are going to be asking us about, especially your clients who are having babies or grandchildren, because the government is doing this trial run where they're going to set up the account and fund it with $1,000. So, what's crazy, not crazy, but there's a lot of uncertainty in here too. The media is, and I don't know who's right or wrong yet. We're going to need IRS guidance on this. But, the IRS tax law that I read the other day, actually going in the code, it says these things are treated as IRAs, but you got to think about it as like a non-deductible IRA because the parent's contribution goes in non-deductible. That leads me to believe, based on how the code is written, that we're going to have to follow the pro rata rule on distributions of these accounts once clients turn age 18. Now, in previous versions of the bill, it actually gave a tax preference to investment gains coming out as qualified long-term capital gains. But in the final version of the bill, that was removed. And I just got a media inquiry about this yesterday. And the reality of it is, I don't think people really know yet. So what we'll also see, and what's going to be an opportunity, is there's more and more provisions where, I think IRS is going to issue some clarity and some guidance on some of this stuff. But, again, I think there's all kinds of strategic planning opportunities on the child-related stuff. Business stuff is huge, 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 huge. Business tax provisions, Section 199A, the qualified business income deduction was made permanent. Now, there was some talk about maybe them increasing that to 23%. That didn't happen. It's still flat at 20%. For all of us, it sucks because they were talking about eliminating the SSTB, the specified service industry, that didn't happen. So we're still mostly phased out for those of us that have specified service businesses that are high income. But it did give a little bit more flexibility. It enhanced the ranges a little bit. So there's all kinds of 199A changes that were made that are going to be, really impactful for businesses. 100% bonus depreciation is back and in action. If you remember, this was going to get phased down. I think it was 60% this year, and then going to 40% next year, and then 20%. We're back at 100% bonus depreciation. I just had a client a couple months ago, had a liquidity event. Wife's company got bought by Amex, and he bought $1 million of equipment, and he's doing equipment leasing now. We're able to bonus depreciate pretty much that whole thing and take $1 million tax deduction, even offsetting a lot of the W-2 income that they have. So there's unique planning strategies there. We have a little bit more wiggle room with Section 179 depreciation also. So, again, for your business owners, I'm talking about what assets we might think about buying and how we're going to, navigate depreciation. Do we want to elect bonus depreciation? Do we want to, smooth out depreciation over years? Do we want to use more of a sniper approach with Section 179? Research and development tax credits are back and they can fully be expensed in the year. Before we had to amortize them over like a 5-year period. So your clients who are investing in their business might be able to secure them up some tax credits. Business interest deduction is going to return to EBITDA instead of EBIT. This is a big deal for any of your real estate owners, or maybe they own a business, but they also own their office building and they're financing it. They had limitations on how much business interest they can deduct. But by adding the DA, the depreciation and amortization, they might actually be able to deduct a lot more interest now instead of just EBIT, which, doesn't allow for depreciation and amortization to be included in there. So there's all kinds of integration strategies for business owners. There's some key changes with qualified opportunity zones. I'm not going to talk about them today, but we're in the process of approving a new qualified opportunity zone on our platform at Prosperity. I think this is going to be a great planning opportunity. Probably one of the dark nights of the tax bill for some of our entrepreneurs and business owners was the continued expansion of qualified small business stock, Section 1202. This is where if your client is eligible as a qualified small business and they sell their company after holding it for a certain period of time, they used to be able to exclude up to $10 million of long-term capital gains from federal taxation. Well, that 10 million now turned to 15 million. And there's some phase-ins where they don't have to hold the stock for as long. But like I have a client, they own a business. It's been around for 9 or 10 years. We taught them about Section 1202, and he was waiting to sell his business because he was to his net after tax number to supplement him and his wife's retirement. Because we were able to show them how we can sell this entire company income tax free, he now can sell the business a lot sooner to get to the net number he needs as his income, gap to sustain his lifestyle. So that's huge. Charitable giving is changing. There's a non-itemizer deduction of $1,000 or $2,000. So your clients who maybe, aren't itemizing can pick up a small deduction. But there's also going to be a floor for our itemized deductions that the first half of 1% basically gets excluded from them being able to deduct it. So there's some kind of like similar to think about the medical 7.5% itemized deduction. You have to get over 7.5% of your AGI to write off medical. Charitable is now 0.5%. So just some, things to think about with high net worth and charitable giving planning. And then I just kind of outline a bunch of other notable provisions. Adoption credit enhancements, dependent care assistant goes from $5,000 to $7,500. There's some really unique employer child care enhancements. We talked about the energy credit phase out, 529 plan expansions. If you have any clients that are professional gamblers that are hit hard because now you could only deduct 90% of your losses instead of 100% of your losses. And so it'll be interesting to see how that impacts the casino business. But all of these things are like really awesome, interesting planning opportunities that, we're going to talk a lot of strategies around. And then last, and I think most important to all of us in the 10 seconds I have left here, is just the importance of tax efficient portfolio design. With the advancements of SMAs and ETFs for tax efficiency and tax harvesting opportunities, it's even more important that we pay prudent attention to our clients' post-tax money, because so many of these provisions have phase outs that if you have one big capital gain distribution from a mutual fund, not only might it cause additional capital gains tax, but it might blow you out on some of these other phase in and phase out deductions. And so there's just so much cool stuff here we're going to be able to share with clients. And like just even you being on this meeting today, you're going to be ahead of anybody else in your community of being able to talk about these things.
Well, Dave, I think I speak on behalf of all of us that we are so glad we have you. So. That is a lot that you've gone through just in that short time. So, Dave, once again, thank you so much. Can't wait to see you all at Tax Management Journey, and see you next week on another coffee break.
Thanks for tuning in to the Bucket Plan on Demand, brought to you by C2P, an organization whose purpose is to educate, train, grow, and support holistic financial advisors so families can achieve true prosperity. Subscribe today for the latest episodes and insights. Visit c2penterprises.com to learn how we can help support and enhance your advisory business. At the time of delivery and any subsequent publishing, information was deemed reliable, but is subject to change by the time of listening or viewing. The contents of this piece include options and projections of C2P, are subject to change, and are for informational purposes only. The information provided in this presentation is not intended to be individual investment, tax, or legal advice.